You cannot have this system that we have right now without money creation. You cannot have a strong dollar without creating money to service the debt. And I think they understand that. So they're giving in and falling on the sword of inflation. So I guess we'll see what the next several weeks have in store for us. But I think this is just the beginning. I would expect it to get worse in terms not only of inflation, but also in terms of countries moving away from the dollar and choosing alternative assets as we lower interest rates, which is the worst possible thing we could be doing.
Global central banks are increasingly turning to gold as part of a larger effort to reduce their dependence on the US dollar. Despite high gold prices, July saw a sharp rise in gold purchases, with central banks adding 37 tons to their reserves, a 206% jump from the previous month. This trend highlights growing unease over the dollar's stability, concerns about inflation, and the potential risks tied to US treasuries in geopolitical conflicts. China sold $22.7 billion in US treasuries in February, dropping its total holdings to $775 billion. Saudi Arabia's recent purchase of 160 tons of gold from Switzerland in August highlights a significant financial shift, as noted by Andy Schectman in his recent interview with CapitalCosm. This move indicates a quiet but decisive move away from reliance on the US dollar, similar to China's discreet accumulation of gold. By keeping this strategy under wraps, Saudi Arabia recalibrates its economic approach without attracting global scrutiny. The kingdom's decision to end its 50-year petrodollar agreement with the US underscores its shift toward diversification. Previously, Saudi Arabia sold oil exclusively in dollars and invested surplus funds into US treasuries. However, the increasing risks associated with these treasuries, exacerbated by the freezing of Russian assets, have eroded confidence in the dollar's supremacy and sparked concerns among other nations about the safety of their reserves. Andy highlights that the U.S. Federal Reserve's inflation management efforts are falling short, with many suspecting actual inflation is higher than reported. This has led to a gradual decline in the dollar's value, making it less attractive for countries like Saudi Arabia to sell their oil for a currency that loses purchasing power. In contrast, gold has become a preferred asset, now classified as Tier 1 by the Bank of International Settlements. Central banks increasingly accumulate and repatriate gold, signaling a loss of confidence in the US dollar's stability. We will present clips from Andy Schectman's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
There is some truth in that, in the respect that the entities that are accumulating gold, largely the central banks, understand that holding dollars is not smart, that they will be eroded to inflation. And think of it from the standpoint of like Saudi Arabia, okay? One of the newsworthy stories is that Saudi Arabia secretly purchased 160 tons of gold from Switzerland in the month of August. And they say secretly because they didn't make a public announcement or any disclosure of the change in their official reserves. Well, China's been doing this forever. Most of the countries who accumulate gold don't want to tell the world how much they own, or they'll say, we're not buying this month, and then it's exposed that they were lying because the import numbers that are required to be detailed by the banks, well, they say otherwise. And I knew that they were still buying, but the point of it is that, think of it from your Saudi Arabia, right? So they've been loading up on gold, and they're trying to do it quietly and covertly so as to not upset the West. What did they do a few weeks ago? They said, hey, we'll still take dollars, but we're not going to do it exclusively. We're going to not re-up the exclusivity of the petro deal that's 50 years old. So what that says to me is that the hegemony is dead, not the supremacy. So they're playing both sides. But okay, let's just say we're Saudi Arabia, and the deal that we had for 50 years is we're going to sell oil to you through OPEC in dollars to the world. And then we'll take any excess and put them into treasuries. Well, the treasury side, you and I have covered extensively. I mean, they've been weaponized, right? We take Russia's $5 billion in treasuries because we don't like what they're doing, and we buy weapons from the military-industrial complex with it to give to the country they're in a war with, the Ukraine. That doesn't go over well to the rest of the world. We are supposed to be impartial. We're not. And by many people's estimation, we're more hypocritical and worse than anything Russia has done. I'm not going to debate that, but part of the world feels that. Okay, so the treasury market is not looked at the same way. And gold which has doubled the performance of the Treasury over the 10-year, over the last 25 years, has no counterparty risk. Okay, fine. So we don't want treasuries anymore. We're going to buy gold with all the excess because it's better. The performance has no counterparty risk. That the Bank of International Settlements is reclassified as the world's only other tier one asset, that the central banks are buying at a level the world has never seen before and repatriating it, including Saudi, who brought all their gold home from the Bank of England and the New York Fed, the two traditional places of safety that would give access to the hubs of trading, the LBMA and the COMEX, or do you want gold? And I think that's what these entities are doing. They're saying, I don't want dollars anymore. They can be weaponized. They're being inflated. It's crap. I'd rather have gold, which has a much better track record, which can't be inflated, which can't be weaponized, and has been reclassified the world's only other tier one asset by the most powerful bank on the planet. The handwriting is right there, and you can see it. So it all goes back to this bullshit that we see coming out of the BLS, the lying to the world about inflation, about job creation, about all of these things. It's a lie, and I think much of the world understands this. Too bad the people in this country don't. Maybe the people watching you and I do, but yeah, this is something that's only going to get more and more acute, I think, as we see what the Fed will do, as they are trapped like a wild animal, literally between the forces of inflation and austerity. The only problem is austerity in this case means blowing up the whole system because they allowed it through 20 years of suppressed interest rates to become so leveraged that any chance to go back to any semblance of normal would mean having to blow up the system. You cannot have this system that we have right now without money creation. You cannot have a strong dollar without creating money to service the debt. And I think they understand that. So they're giving in and falling on the sword of inflation. So I guess we'll see what the next several weeks have in store for us. But I think this is just the beginning. I would expect it to get worse in terms not only of inflation, but also in terms of countries moving away from the dollar and choosing alternative assets as we lower interest rates, which is the worst possible thing we could be doing.
The recent signals from the Federal Reserve regarding potential interest rate cuts have ignited significant discussion among economists and market analysts. On Wednesday, the Federal Reserve implemented its first interest rate reduction since the onset of the COVID-19 pandemic, lowering benchmark rates by 50 basis points to mitigate risks of a slowdown in the labor market. With signs of easing job growth and inflation, the Federal Open Market Committee adjusted the key overnight borrowing rate, aligning with market expectations that had shifted from anticipating a smaller reduction. Andy points out that the Fed may consider an additional 50 basis points in cuts over the coming year. Andy's analysis shows a growing belief that actual inflation rates may be significantly higher than the government reports. Some experts estimate inflation could be around 11%, sharply contrasting with the official figure of just over 3%. The dollar's declining value is a direct consequence of these inflationary pressures. It has raised significant concerns, particularly for nations like Saudi Arabia, which rely heavily on oil sales. As the dollar weakens, the potential for diminishing purchasing power makes transactions tied to this currency less appealing for these countries.
The Fed is full of shit, and you can't really take anything they say with a grain of salt. I mean, in the respect that, going all the way back to 2008 when Bernanke said the subprime crisis was contained, only to watch it blow up a week later. And the same thing is true here. There is no inflation, and then it's okay, it's only transitory, and well, then it's structural, then it's contained. And I mean, everything that they talk about just seems to be mistimed. They're talking about, in this case, lowering the federal funds rate by 50 basis points because of their dual mandate of not only fighting inflation, but also making sure there's full employment. Well, the numbers, as we know, that come out of the Bureau of Labor Statistics are fugazi. We know that. They went back and adjusted 818,000 jobs, but that doesn't take into account the couple 100,000 that they did during the year last year. So over 1 million jobs just vanished, and they touted every single month what great job they were doing on fighting, not only inflation, but making sure that the economy was strong. And so inflation is in essence almost 4 times as high as they are telling us, yet they're touting 3% or just over 3.5%, right in that range, as where they're going to pivot. That's 60+% away from where they wanted to be at 2%. They haven't tackled inflation. They haven't beaten inflation. In fact, they've raised the red flag to inflation, the way they always have, the way that all governments have, and in terms of normalizing their balance sheet or quantitatively tightening, you get rates up to 5% and the whole thing starts to blow up, just like it started to blow up in 2019 when they tried to raise rates and the subprime crisis happened, just like when the UK tried to normalize their balance sheet and raise rates. What happened? The pensions started to blow up, so they backed off, just like Japan tried to normalize their balance sheet and raise rates. What happened? The Nikkei collapsed, the Dow Jones collapsed, the markets in Singapore and South Korea collapsed. All of these markets collapsed. The carry trade, they backed off. So the point of it is that we've reached a point where we're trapped between inflation and austerity, and governments do what they always do, and that is to choose inflation. Now, the question becomes, what are the unintended consequences? Think about the yen carry trade for a moment. The yen carry trade blew up because rates on the yen went up a tiny bit and the yen strengthened. So wouldn't it be the same thing if the dollar loses ground and rates fall a little bit on the dollar? Because if you're lowering rates, the dollar should fall. And it's the exact same thing in reverse. Are there consequences lurking in the weeds that we don't see? What we are doing is reigniting the inflation engine. And I think that's why you see gold, which they tried to hit right after the announcement, but here it is right back up to $2,600 an ounce, silver back to 31. I think that it's predictable. The question is, do they continue to go down this road and lower rates? If we do, you might as well just put your head between your knees and kiss the dollar goodbye. Because if we continue to lower rates and to give in to inflation, it's over for the dollar on a long-term basis. And what's interesting, you can kind of see that in a microcosm. They lower rates, and what was the first thing that happened? The back end of the curve went up. So the yield on the 10-year treasury went up as they lowered rates on the front end. And that's just, I think, the world's way of saying, you guys are idiots, and we don't want your duration treasuries of any duration, because why would we? You're going to inflate the hell out of the currency. You're manipulating the treasury market, and in fact weaponizing the treasury market, and your country's a mess. Why do we want your treasuries? Tell us why we should buy it when you're lowering rates, yet you're creating inflation as if money is going out of style. These are very interesting times, to say the least.
On Friday, the gold market experienced a rally, driven by positive momentum following the Federal Reserve's 50 basis point interest rate cut. This development underscores gold's long-term outlook, especially as uncertainty regarding risk appetite persists. Concerns are growing that the Federal Reserve is responding urgently to economic challenges, positioning gold as an attractive safe haven asset for investors amid ongoing market volatility. Share your thoughts on Andy's analysis in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.